Back in 2008, the entire global financial system was teetering on the edge of a cliff. I mean, we're talking about a near total collapse, the kind of thing we hadn't seen since the Great Depression. And this wasn't just some abstract Wall Street problem, no. This crisis hit Main Street, and it hit hard. So today, we're going to unpack exactly how it all went down, piece by terrifying piece.
And look, don't just take my word for it. This quote, this is from the U.S. Treasury itself. This wasn't some kind of media hype. This was the real deal. The stakes were absolutely as high as they could get. It was just pure, raw economic panic. That terrifying feeling when the floor beneath your feet is about to crumble away. And that panic? It had absolutely devastating consequences in the real world. I want you to just imagine for a second. The entire system of credit, gone. No car loans, no student loans, no small business loans. Everything just frozen solid. That's what was happening. We're talking about nearly 800,000 jobs vanishing every month. And people's life savings, their home equity, a huge chunk of it, just poof, gone. This thing reached into every single corner of the economy.
All right, so how on earth did we get to the edge of that abyss? Here's our roadmap for this explainer. We'll look at the subprime boom, then the wild bets that were being made, then we'll watch the dominoes fall, and finally, see how the government tried to step in.
Okay, let's get right into it. To really understand the explosion, you gotta look at the fuse. And that fuse, well, it was lit way back in the US housing market in the early 2000s.
So, the absolute core of the problem started right here. You know, normally to get a mortgage, you need a pretty good credit history, a decent down payment, all that stuff. But in the early 2000s, things changed. Lenders started handing out loans to what they called subprime borrowers. Basically, these were folks who in the past would have had a really tough time getting a loan. All of a sudden, the doors to buying a house were flung wide open for almost everyone.
But here's the catch. The lenders making these loans didn't actually hold on to the risk. Instead, they built this incredible financial pipeline. Here's how it worked. Step 1, make a bunch of risky loans. Step 2, take thousands of these mortgages, chop them up, and bundle them together into these really complex new things called mortgage-backed securities. Think of it like a financial smoothie where you can't taste the individual ingredients anymore. And then step 3, they sold these bundles to investors all over the globe. The risk wasn't just in one place anymore, it was everywhere.
And here's the really crucial part. For a while, this whole system seemed like magic. It looked like a foolproof plan, because as long as house prices just kept going up and up and up, everything was fine. If someone couldn't pay their mortgage, no problem. The bank would just take the house and sell it for an even higher price. This created this massive feedback loop, a sense of safety that just fueled more and more risky lending, which pushed prices even higher. There was, a perfect bubble. Okay, so you have a housing bubble, but how does that get supercharged into a full-blown global catastrophe? Well, it all comes down to a really powerful, super complex, and almost completely unregulated financial tool.
Let's talk about something called a credit default swap, or CDS. Now, the simplest way to think about it is like an insurance policy on debt. So if you're an investor and you own one of those mortgage bundles, you could buy a CDS to protect yourself. If your investment went bad, the person who sold you the CDS would pay you. On the surface, it sounds like a smart way to manage risk, right?
Well, here is the absolutely critical, game-changing difference. To get insurance on your house, you have to own the house, right? Makes sense. But with a credit default swap, you did not have to own the thing you were insuring. This is huge. It meant you could buy a CDS on your neighbor's house, essentially placing a bet that it would burn down. It turned what was supposed to be a tool for protection into a gigantic, unregulated global casino.
And that's why the legendary investor Warren Buffett famously called these things financial weapons of mass destruction. It was a perfect storm. You had the ability to make these enormous bets that something would fail, and it was all happening in this dark, hidden market that nobody was really watching. The system was basically planting these little financial time bombs all over the world, and nobody knew when they were going to go off.
And get this, just try to wrap your head around the scale of this thing. At its peak, the value of this shadow market, all these side bets, was estimated to be $62.2 trillion. Trillion, with a T. That is more money than the entire economic output of every country on Earth combined. It was an absolutely staggering amount, and it was all connected in this complex, tangled web that honestly, nobody fully understood.
So, what happens when the music stops? What happens when that one single belief holding this entire house of cards together, the idea that house prices only go up, turns out to be wrong?
Well, let's watch it all come crashing down.
Okay, so the first little cracks start to show in 2007. House prices finally peak, and then they start to fall. All those subprime borrowers, they start defaulting, and they start defaulting in droves. But the real earthquake, the moment the ground beneath Wall Street just completely gave way, was September 15th, 2008. That's when Lehman Brothers, this giant 158-year-old investment bank, filed for bankruptcy. And the shockwave wasn't gradual, it was instantaneous. Panic just exploded across the entire planet.
And this right here perfectly shows you how those credit default swaps acted like gasoline on the fire. Lehman Brothers itself, it had about $155 billion in debt. A huge number for sure, but the value of all the bets, all the CDSs made on Lehman failing, that was $400 billion, more than double. So the losses weren't just about what Lehman was worth, they were massively amplified by this mountain of side bets.
And just like that, you realize everyone is connected to everyone else. It's a true domino effect. A bank in Germany suddenly finds itself on the brink of collapse because of a bet it made with a hedge fund in London, which was tied to a pension fund in Japan. This is what we call systemic risk, and it's absolutely terrifying. The failure of one company wasn't just about that one company anymore. It threatened to set off a chain reaction that could bring the entire global system down.
So with the entire financial world literally staring into the abyss, the US government had to do something. They were forced to take actions that were completely, totally unprecedented. The main tool they came up with was the Troubled Asset Relief Program, better known as TARP. And the basic idea was pretty straightforward. The government would step in and use taxpayer money to buy up all those troubled assets, the toxic mortgage stuff that nobody wanted, and even buy stakes in the banks themselves just to keep them from going under.
Now, there's a really common misconception about the cost of this so-called bailout. The big scary number everyone remembers is $700 billion. That's what Congress authorized. But they didn't actually spend all of that. And over time, as the banks got stable and paid the money back, the final net cost to the taxpayer ended up being much, much lower, around $31 billion.
And it's really important to understand what the government's goal was here. They weren't trying to make money. They were acting like firefighters rushing into a burning building. The whole point was to stop the free fall, to get credit flowing again, and to prevent millions more people from losing their jobs and their homes. It was an emergency stopgap to prevent a second Great Depression, even though, of course, it kicked off a massive and very valid debate about bailing out the same people who started the fire. So let's just do a super quick recap. It all started with risky home loans. That risk got blown up to an insane degree by these unregulated side bets. When the housing music stopped, the whole house of cards came down, and it took a massive controversial government intervention to stop the entire world economy from going down with it.
So yeah, the immediate fire was put out. The world was pulled back from the brink. But it leaves us with this huge lingering question that we're still debating. Did the response actually fix the problem? Did it teach the big banks that they could take insane risks and always get saved? Did the new rules actually make the system safer, or did we just put a Band-Aid on a bullet wound? That's not just some academic question, it's something that affects all of us and our future.